December 8th, 2025. Silver is trading close to $58 per ounce, nearly at its highest price ever. But here is the important point. While Western investors are arguing about whether this price rise will continue, something else is happening that almost no one is discussing. China and Russia are doing more than just buying silver. They are changing their entire strategic reserves to include it. If the information I've been studying is correct, we are not just watching a price increase. We are watching the start of a worldwide supply problem. This is not about guessing the next $5 or $10 increase in price. This is about understanding a major change happening right now. A change where the world's second and 11th largest economies are steadily buying physical silver, while global supplies are running low. Let me show you exactly what is going on, why it is important, and what the facts tell us about where this is heading. I am not a financial expert. This is not financial advice. This is just an educational study based on facts that are public. You must make your own choices. Let us begin with what is truly happening now, because the basic numbers do not tell the whole story. Silver ended 2024 up by about 21%. That is strong performance. But look closer, and you will find something bigger. Russia made an announcement in 2024 that changed everything. For the first time in over 50 years, a major nation officially said that silver is a strategic reserve asset. The Russian Finance Ministry set aside 51 billion rubles, which is about $535 million, specifically to buy precious metals between 2025 and 2027. Not just gold, but also silver, platinum, and palladium. This is a huge change. Central banks stopped using silver as a money reserve in the mid-1800s. For 170 years, silver was used for industry and investment, but not as an official reserve. Russia has just reversed that 170-year-old practice. Why is this important? Because Russia is not acting alone. China has roughly 70,000 metric tons of silver reserves in the ground. That is the third largest amount globally, after Peru and Russia. But here's the interesting part. China's known use of silver tells a different story than how much they produce. China produced 30,300 metric tons in 2024, but China's need for industrial uses, especially for solar panels, electric cars, and electronics, uses much more than they produce. Market experts say China now makes over 80% of the world's solar panels. Every panel needs silver paste to carry electricity. Production of electric vehicles in China went up 40% compared to the previous year. Every electric car uses about twice as much silver as a normal car. The expansion of 5G networks keeps growing. Every tower needs silver parts. The numbers do not make sense unless China is importing huge amounts, and they are. But the real question is not how much they are buying. The question is, why are they buying now? And why is Russia, which is facing economic restrictions from the West, choosing to put over $500 million specifically into silver? The answer becomes clearer when you look at the supply. The Silver Institute reported something important in their 2025 World Silver Survey. The global silver market is entering its fifth straight year of a structural shortage. Let me explain what that means. In 2024, the total need for silver was about 1.16 billion ounces. The total supply, including mining and recycling, was about 1.01 billion ounces. That is a shortage of roughly 148.9 million ounces in just 1 year. But here is the crucial point. From 2021 through 2024, the total shortage has reached 678 million ounces. That is the same as 10 months of all the silver mined globally in 2024. It is gone, used up, and not replaced. And 2025 is also expected to have a shortage. The market is using more silver than it produces year after year. Where is the extra silver coming from? From above-ground reserves, vaults, and stockpiles, and those are running low. The amount of silver registered for immediate delivery on the COMEX exchange shows this clearly. In February 2021, COMEX had about 152 million ounces of registered silver. By late 2024, that number dropped to about 73 million ounces. That is a drop of over 50% in less than 4 years. Storage vaults in London show similar trends. The London Bullion Market Association reported that silver reserves fell to about 827 million ounces in December 2024, near the lowest ever. And roughly 551 million ounces of that are reportedly set aside for investment funds. That leaves about 276 million ounces available for trade. Now, think about this along with industrial demand. The need for silver in industry hit a record 680.5 million ounces in 2024. This is the fourth year in a row of record demand. This is not for investing. This is silver that is being used up and consumed. Solar panels, electronics, medical uses, 5G networks, and AI data centers all require silver. And this demand is growing. Solar power uses alone consumed about 197.6 million ounces in 2024. That is nearly 30% of all industrial demand. Solar installations doubled in 2024. Governments worldwide are requiring more renewable energy. That means more panels, more silver usage. This is a structural, continuing, permanent demand. This is where China and Russia fit in differently. They are not just passive industrial users. They are strategic buyers getting ready for a supply crisis they see coming. Russia's plan to spend $535 million over 3 years on precious metals is not random. It is planned. Russia produces about 28% of the world's platinum. They are a major producer. Yet, they are buying precious metals, including silver, as strategic reserves. Why? 2 reasons. Sanctions. The freezing of about $300 billion in Russian reserves in 2022 taught Moscow a lasting lesson. Dollar and euro reserves can be seized or frozen, but physical precious metals kept in vaults at home cannot be taken. Silver, like gold, is safe from sanctions. Industrial strategy, Russia sees what is ahead. A world that is becoming electric. A world building 5 grams and 6 grams networks. A world that needs silver for key technologies. And Russia is aiming to have the supply when others do not. China's plan seems different, but is just as carefully thought out. China does not announce silver purchases the way Russia does, but their import numbers show they are constantly accumulating it. Experts studying China's silver plan notice something important. From 2010 to 2022, when silver prices were relatively low, China might have been buying up silver strategically, similar to what they have done with gold. China's official gold reserves reached 2,279.57 tons by the end of 2024. That is officially recorded. They have been buying steadily since 2015. If China did even a small part of that with silver, given their dominance in industry and future technology needs, the amount they have accumulated would be large. And here is the most important part. Both nations are buying while prices are still relatively fair, and while physical supply is still available. This is a recognized pattern. History shows that nations build strategic reserves before a crisis, not during one. Look at what happens when major powers buy resources before a shortage. Gold provides the example. Central banks worldwide bought over 1,000 tons of gold annually for 3 straight years, 2022, 2023, and 2024. That has never happened before. The result? Gold prices went from about $2,000 per ounce in early 2024 to pushing $4,200 in December 2025, a gain of over 100%. Why? Because continuous demand from buyers with unlimited money sets a permanent minimum price. Central banks do not panic sell. They buy and hold, which permanently removes supply from the market. Now, apply that idea to silver. Russia officially making silver a strategic reserve. China using more than it produces. Both nations representing major economic power, competing for a limited physical supply. And they are not the only ones. Reports say that Turkey, India, Poland, and other nations greatly increased their precious metals reserves in 2024. The trend is spreading. As the dollar's power slowly decreases, as global tensions increase, and as Western financial systems show they will use access to money as a weapon during conflicts, nations are protecting themselves. Physical assets, domestic vaults, moving away from paper promises. This creates a specific problem for the silver market. Unlike gold, where the annual mine production is about 3,000 tons and above-ground stocks are enough for decades, silver is different. About 70% of silver is a byproduct of other metal mining, copper, lead, zinc, gold. This means silver supply does not easily change based on its own price. If copper prices are not high enough to open new mines, the silver that would have come out as a byproduct is never produced, and the prices of copper, zinc, and lead in 2024 were not strong enough to start major new mine projects. Mines focused only on silver are declining. Primary silver supply fell to about 227.5 million ounces in 2024, continuing a long-term downward trend. The best, most accessible silver was mined decades ago. What is left requires more money, more energy, and more processing to get less metal, which is tough to do at current prices. Recycling should help, but silver recycling has limits. Only about 18% of the silver used in electronics is recovered. Solar panels lock silver away for 25 to 30 years. Industrial processes are designed to use less silver, not to create more recyclable waste. Recycling added about 193.9 million ounces in 2024. That is helpful, but nowhere near enough to close a 148 million ounce shortage. So, here is the situation. Structural supply shortage. 5 years straight, industrial demand at record levels. Mine supply is relatively flat. Recycling is insufficient. Above-ground reserves are running out. COMEX registered stocks are down 50% since 2021. London vaults are near all-time lows. And now, two major nations, China and Russia, are systematically buying physical silver as a strategic policy. What happens next is not guesswork, it is the mathematics of supply and demand. When demand is constantly higher than supply, one of three things must happen. Price rises until demand is stopped. Industrial users switch to cheaper materials. Solar makers use less silver per panel. Electronics companies change their designs. But silver's unique qualities, the best electrical conductivity of all metals, make it hard to replace. And green energy plans mean solar demand is not optional. It is required by policy, making it a permanent demand. Supply increases greatly. New mines open and production goes up. But mining takes 5 to 10 years. Finding a deposit, getting permits, funding it, yielding it, and ramping up production takes years, not months. And since silver is mostly a byproduct, supply increases require base metal prices to surge first. That has not happened yet. Available inventory runs out. This is the critical part. Physical shortages appear. Prices shoot up. Delivery times get longer. The paper market, futures contracts, and investment funds stops matching the physical reality. We have seen this before. In 2020, during the COVID crisis, silver's price hit about $28 per ounce. But physical coins and bars were selling for $45. That is a premium of about 60%. The paper price said $28, the physical market said $45. The disconnect lasted months. Why? Because when everyone wants physical metal at the same time, there is not enough to go around. Mints could not keep up. Dealers had long waiting lists. Premiums exploded. That was a temporary panic. Imagine what happens when the shortage is structural. When it is not panic, but mathematics. 5 straight shortage years become 6, 7, 8. COMEX registered silver falls from 73 million ounces to 50 million to 30 million. At some point, the available physical supply becomes so low that the paper market is no longer believed. This is why China and Russia's timing is clear. They are accumulating now, while physical metal is available, while premiums are reasonable, and while the market is still working normally. They are not waiting for crisis prices. They are positioning before the crisis. This is the most basic rule of strategic reserve building. You do not announce you are buying at the highest price. You accumulate quietly when no one is paying attention. Then, when supply tightens and prices move, you are already positioned. Russia's public announcement of $535 million for silver over 3 years is not panic buying. At current prices, that is roughly 9 million ounces per year. A huge amount, but it is official, recorded, and budgeted. That means they see this as a long-term strategic necessity, not speculation. China's approach is less public, but potentially larger. Their industrial usage alone requires them to import hundreds of millions of ounces. If even a small part of that is being bought and held beyond immediate industrial needs, the numbers quickly become significant. Now, let us discuss what $61 per ounce means, and if that price can hold. Silver reached about $59 in early December 2025. That is close to the all-time high when adjusted for inflation from 1980. Back then, the Hunt brothers drove silver to about $49 before the exchange changed the rules and forced them to sell. Adjusted for inflation, that $49 equals roughly $170 in today's money. But here is the difference. The Hunt brothers were high-risk speculators. The exchange could change the rules and force them to sell. The Hunts lost, but the shortage was real. And the fundamentals were real. It took changing the entire game to stop the price rise. Today's situation is different. This is not about two billionaires trading with borrowed money. This is about sovereign nations with unlimited funds, multi-year plans, and strategic mandates. You cannot demand a country repay its debt immediately. You cannot change exchange rules on national reserve policies. According to various expert predictions, silver targets vary widely. Some suggest $75 to $90 by the end of 2026. Others, looking at the historical gold-silver ratio of around 15 to 1, suggest silver could reach $280 if that ratio returns to normal. Currently, the ratio is about 72 to 1, gold near $4,200, silver near $58. Historically, silver has followed gold, but with more dramatic, faster, and more explosive moves. If gold continues toward $5,000, and the gold-silver ratio decreases even a little toward historical norms, silver mathematically reaches $150 to $200, not because of speculation, but because the ratio returns to its long-term average. This happens naturally when the fundamentals line up. And right now, the fundamentals are out of line. Silver is undervalued compared to gold, undervalued compared to its industrial importance, undervalued compared to the reality of the supply shortage. But the real driver is not the ratio returning to normal. The real driver is the physical shortage becoming undeniable. When COMEX registered silver falls below 50 million ounces, the system is under stress. At current usage and drain rates, that could happen within 6 to 12 months, maybe sooner. When London vaults lose another 100 million ounces, market players start questioning if there is enough metal to back all the paper claims. Investment funds hold about 820 million ounces globally. But how much of that is truly separate, assigned, and ready? These questions matter when supply is tight. The situation reminds me of the 2021 nickel short squeeze on the London Metal Exchange. Nickel prices shot up 250% in 2 days because a major short seller could not deliver the physical metal. The exchange stopped trading and canceled trades. Chaos resulted. But the key message was clear. When paper markets face stress over physical delivery, anything can happen. Rules change and trust breaks down. Silver faces similar issues, but on a bigger scale. The COMEX silver market has contracts open that represent about 226% of all vaulted silver. That means there are more than 2 paper claims for every ounce in the vaults. And 1,802% of registered silver specifically. That is 18 paper claims for every registered ounce available for delivery. The risk is extreme. The system only works as long as everyone does not ask for physical delivery at the same time. What happens when China or Russia, nations with official strategic reserve policies, decide they want physical delivery against futures positions? What happens when industrial users facing multi-year contracts demand physical settlement instead of cash? The pressure on registered silver would be immediate and severe. Premiums would spike, and delivery times would get longer. The difference between the paper price and the physical availability becomes the main story. This is the pattern I have been studying. And it is not a guess, it is an observation. All the pieces are falling into place. Structural shortage, check. Inventory running out, check. Strategic buying by major powers, check. Industrial demand at records, check. Mine supply unable to increase quickly, check. Every factor needed for a supply crisis is present right now. The only question is timing. Based on what has happened before, major price moves driven by supply happen when a physical shortage becomes undeniable. Not when traders talk about it, but when industry cannot get the metal, when mints limit product, and when dealers have 6-month waiting lists. That is the trigger. And based on inventory trends and the persistent shortages, we are closer to that trigger than most people realize. The Federal Reserve meeting in December 2025 adds another factor. If they lower interest rates, as most markets expect, the dollar weakens. A weaker dollar usually helps precious metals, gold and silver. More importantly, rate cuts signal economic worries. Worries lead to demand for safe havens, physical assets over paper promises. This benefits silver. The global situation also matters. U.S.-China tensions continue. Russia is still facing sanctions. The Middle East remains unstable. The dollar being used as a weapon in 2022 with Russia's reserve freeze taught every nation a lasting lesson. Your reserves are not safe if they are. Paper promises in someone else's system. Physical assets in your own vaults. That is real security. This is why central banks worldwide bought over 1,000 tons of gold for 3 straight years, and why Russia becoming the first nation in 50 years to officially add silver to strategic reserves is important. It makes silver a monetary metal again. Other nations watching may follow: Turkey, India, Saudi Arabia. Nations moving away from depending on the dollar. Nations with industrial economies that need silver. Nations wanting reserves that are safe from sanctions. If even a small part of central bank buying shifts toward silver, the way it has for gold, the impact on a market with only 1 billion ounces of annual supply would be dramatic. The effect is asymmetrical. Small amounts of capital moving into silver have a big impact on the price because the market is much smaller than gold, stocks, or bonds. And if China and Russia are moving first, positioning while others hesitate, they are securing supply at prices that will look cheap later. So what does $61 mean? It means we are at the point where historical resistance meets the reality of the structural shortage. It means the market is pricing in some chance of a shortage, but not a certainty. If a shortage becomes certain, if physical metal becomes truly scarce, the price increase will not be gradual. It will be explosive. $70, $80, $90, and $100 come quickly when supply-demand dynamics break down. We saw it with copper and palladium. We are seeing it unfold with silver now. The difference is that silver is both a precious metal and a critical industrial material. It is money when people lose faith in currency. It is a necessity when industry needs conductivity, reflection, and germ-killing properties. You cannot print more of it. You cannot easily substitute it. You either have it or you do not. And increasingly, as China and Russia position strategically, as industrial demand sets records, as mines cannot keep up, and as inventories drain year after year, the answer is becoming clear. There is not enough, at least not at current prices. This is an educational analysis based on public facts, supply shortages, inventory trends, nation-state buying, industrial demand, and mine supply limits. All are factual and recorded. The conclusion that these factors lead to higher prices is logical. It is pattern recognition. History repeats. And right now, history is matching every major commodity shortage of the past 50 years. Early accumulation by those with information. Denial by most people. Then the shortage. Then the price explosion. Then everyone saying it was obvious. We are somewhere between denial and shortage. That is where the opportunity is for those paying attention. But it is also where the risk is highest for those who are unprepared. Understand what is happening. 5 straight years of shortage. China and Russia positioning. Inventories running low, industrial demand surging, mine supply stuck. Everything points in the same direction. And the direction is more important than the price. $58, $61, $70. The exact number today does not matter. What matters is the path, and the path is up. Structurally. Constantly. Until supply increases, demand falls, or price reaches levels where both happen. None of those are about to happen immediately. The price is the adjustment mechanism, and it is just beginning to adjust.